under the general rubric, is there a better way to regulate mutual funds? This is the 9th conference we've had on this subject. There will be several more. But this one promises to be, I think, one of the most interesting, if not controversial. Our guest and principal speaker today is Jack Bogle, a pioneer in the mutual fund industry and the founder of the very successful and innovative Vanguard Group. I won't go into detail concerning Mr. Bogle's extraordinary career. That's outlined in the biography included in your materials. But suffice it to say that he began looking at the benefits and costs of mutual funds with his senior thesis as a Princeton undergraduate and essentially never stopped. His work as both an innovator and then a critic of the mutual fund industry has earned him, in 2004, Time magazine's listing as one of the 100 most influential men in the world. We were eager to bring Jack Bogle to this podium because his critique of the mutual fund industry has received wide circulation, not just through his books, but through his remarkable speaking schedule and abilities. As the Washington Post once said, he has the mind of an economist and the personality of a preacher. Any study of mutual fund regulation and the structure of the industry, which is what Bob and I are engaged in here, must take into account the Bogle critique, and particularly his recommendations for change, and certainly we will. In his latest book, The Battle for the Soul of Capitalism, which incidentally is on sale in the lobby, and you can get it after the program, or if you're leaving early, you can get it then. Mr. Bogle outlines his prescription for reform. He cites 4 elements in his reform agenda. No more than 1 management company director on a fund board, an independent chair, a fund staff reporting to the independent chair with responsibility for evaluating the investment performance and marketing results of the manager, the reasonableness of fees paid and other relevant information, and a federal statute of fiduciary duty for fund directors. We're eager to hear Mr. Bogle's arguments in favor of these reforms for several reasons. Clearly, this fits in with the kind of study that we have been doing. First, the SEC's 2004 regulation that would have required the chair and at least 75% of the directors of every fund to be independent of the investment advisor was recently struck down by the D.C. Court of Appeals. Because the SEC had failed to consider the effect of its rule on efficiency and competition in the mutual fund industry. In the National Securities Market Improvement Act of 1996, Congress required the SEC to consider these factors, that is, efficiency and competition, when it makes rules. And Bob and I think, certainly I, because I've written a lot about this, would really like to know how Mr. Bogle connects the independent chair and the supermajority of directors with efficiency and competition in the mutual fund industry. Secondly, the only significant scandals in the industry 66-year history were the recent market timing and late trading scandals. Both were discussed extensively in Mr. Bogle's book. The SEC proposed its requirement for an independent chair and an independent supermajority of the board largely as a response to these scandals, and thus essentially implemented 2 of Mr. Bogle's major reforms. I've been trying to figure out how this reform, had it been in effect, would have prevented these scandals. The SEC has never charged any directors, independent or otherwise, with dereliction in connection with the clearly wrongful acts by the fund's advisors, and has never suggested that the directors should have or even could have discovered the wrongdoing. So I have never been able to determine how increasing the number of independent directors from a majority to a supermajority, or making the chair independent of the investment manager, would have been a remedy for the one serious scandal that has ever afflicted this industry. Since it is an important part of his prescription for reform, I am hoping that Mr. Bogle will draw the connection between the reform and the wrongdoing. Third, in his book, Mr. Bogle argues that expenses imposed by investment managers have eaten up very large percentages of the returns that investors might have expected from the growth in the value of their funds. Yet he recommends that the funds themselves have a paid staff to evaluate the work of the investment advisor. Presumably that would add even more costs that ultimately would reduce the yields that investors would get from appreciation of their portfolios. Mr. Bogle does not estimate what these costs could be, but if we were to adopt his idea, I'd like to get some sense of what he thinks these costs might be and how they would increase the returns for investors. More generally, like Jack Bogle, Bob and I are focusing our study on what reforms will improve the returns that investors will get from their mutual fund investments. In looking at mutual funds today, we see an industry with nearly $9 trillion in assets, heavily regulated by the SEC, and largely under the control at the board level of a majority of independent directors, and in many cases, a supermajority. From this arrangement, investors obtain diversification that protects their nest eggs against the kinds of losses suffered by the non-diversified shareholders of, we'll say, Enron and WorldCom. But far from being dissatisfied with what this arrangement is costing them, there are indications that investors are willing to pay even more for investment advice. If I understand the figures correctly, almost 60% of mutual fund investors use financial advisors. Most of them are paid in whole or in part by the investors themselves or through 12b-1 fees that are, in effect, paid by mutual fund shareholders. And how else can one explain the growth of separately managed accounts in which investors pay advisors to set up special, customized, diversified portfolios? One of the alternatives we might consider in our study is the adoption of the reforms that Jack Bogle recommends. But in order to do so, we'd have to see how these reforms cure the problems Mr. Bogle cites or give investors more of what they seem to want. We look forward to Mr. Bogle's remarks, as I'm sure you do, and to the discussion that follows. And now I'm delighted to welcome to the podium Jack Bogle. I will introduce my colleague Bob Lighton and the other speakers after Jack is finished. Please.
All right. I'm sorry about that one. I repeat myself. I'm not sure I've covered in my talk all of the items that Peter mentioned in his generous introduction. But if we haven't covered them in the talk, we will certainly talk about them in the Q&A period. And I hope this will be a no-holds-barred session. And it's very rare for me to get any debate on these ideas I have, which seem to be, as a wise man once said, somewhat out of the mainstream. And indeed they are. But I thank you for the nice introduction, Peter. And it's a real pleasure to be at AEI, be with some industry-savvy participants like John and Jeff, and also these think tank intellectuals at the same time, like Peter and Bob. It's really a treat to be with you, and I love the challenge of that. And I'm going to start off by just mentioning, as a jumping-off point, the new book that I have, Battle for the Soul of Capitalism, published by Yale University Press just last November, and it relates directly to the themes I'll talk about today. The theme of the book is that today's capitalism has departed in many, many areas, not just in degree but in kind, from its traditional roots, a system that served us so well for so long. The system worked, or at least it did work. And then late in the 20th century, something went wrong. A pathological mutation in capitalism, as it's called in the book, in which the traditional system, the classic system, owner's capitalism, based on a dedication to serving the interests of the corporation's owners and maximizing the return on their investment, morphed into a new system, manager's capitalism, in which the corporation came to be run to profit in the corporate area, its managers, in complicity with accountants and the managers of other corporations. This change came in large measure because the markets had so diffused corporate ownership that no responsible owner exists, a corruption of capitalism itself, quoting from the book. Once we were an ownership society, not so long ago either in the whole span of time, in which direct owners of stock held voting control over corporate America, and we've turned in now an agency society, and we are not going back to an ownership society. This move has been massive and unrelenting. As you all know, roughly in 1950, 92% of all stock was held by individual investors and only 8% by institutions. And since then, institutional ownership has soared to 68% from 8%. But while we've replaced our traditional ownership structure, dominated by individuals, with a new agency structure dominated by institutions, we have yet to change the rules of the game. It's a curious fact that my new book echoes, in fact, Peter, in so many ways the principles that I set forth in that senior thesis at Princeton all those years ago, completed in the spring of 1951. Oh my God, 55 years ago. It was entitled The Economic Role of the Investment Company. Read today, I think you would find that the thesis maybe a little bit more than workmanlike, but not much, probably rather callow, but it powerfully, as it happens, reaffirms the ideals that I hold to this very day. The role of the mutual fund, I'm quoting from the thesis now, is to serve the needs of both individual and institutional investors, to serve them in the most efficient, honest, and economical way possible. The prime responsibility of fund managers must always be to their fund shareholders. The primacy of the interest of the owners, getting back to the theme of the book of fund shares, over the interest of the fund's managers. All of this gratuitous advice from a callow college senior was, of course, totally ignored by the fund industry. And the 1974 creation of Vanguard, however, as a truly mutual fund group, operated on an at-cost basis for the benefit of the community of owners rather than the private interest of its managers, was my attempt, it turns out, to walk the walk that I had talked the talk about all those years earlier. Today, probably be evident in my comments this morning, my youthful idealism has not departed. I think it's somewhat worse, shamelessly reflected, not only in Vanguard, but in the new book, and certainly in the commentary you'll hear from me this morning. The pages of the battle for the soul of capitalism divided into three roughly equal sections: corporate America, investment America, and mutual fund America. But I'm going to focus today, of course, on the mutual fund part of that. The fund industry is, in fact, the paradigm, the poster boy, if you will, of the triumph of managers' capitalism over owners' capitalism, given, as the book states and as your invitation to this system, this session repeats, this morning session repeats, quote, an organizational design that would amaze and delight the oligarchs of corporate America, under which the managers of mutual funds have enjoyed virtually free rein to place their interests ahead of the interests of the owners of their funds. Just think about just these two, and I could go way on beyond this, that differentiate mutual fund America from corporate America. Fund complexes, even when their assets exceed $100 billion or $1 trillion, and they do, could easily manage themselves. Yet they find it necessary to be controlled and operated by separate outside managers who are in a business to serve their own shareholders. And number two, another difference, mutual funds are owned almost entirely by investors of modest means, relatively modest means, with very few of those potentially only at the moment, pesky giant institutional owners to be concerned with. As a result, the sound national policy promulgated in the preamble to the Investment Company Act of 1940 that clearly ordains that funds must be organized, operated, and managed, remember those three words, in the interest of their shareholders rather than the interest of their managers and distributors, end of quote, has been honored for far more in the breach than in the observance. It's the disregard of this principle that the interest of shareholders comes first that explains why mutual funds have, as a group, failed to adequately serve their owner investors. It is not just theoretical. The evidence is real and the evidence is tangible. Let me illustrate this point with 6 of the major areas that I see as problems. 1, the mutual fund has changed in the time I have been in it for the worse. All those years ago, as I saw it at least, it was a profession with elements of a business. And it gradually became a business with elements, and too few elements of that, of a profession. Our traditional guiding star of stewardship was largely replaced by a new star, salesmanship. Focused on management. When I wrote that Princeton thesis all those years ago, our predominant focus today is on marketing. The name of the game is increased fee revenues to managers by building up assets under management, often by creating, promoting, and advertising speculative funds that meet the fads and fashions of the day at a staggering cost to fund investors. Point 2, this industry has been taken over by financial conglomerates. When I entered this field all those years ago, first chart, virtually 100% of mutual fund management companies were privately held firms, relatively small firms, and managed by investment professionals. Today, the vast majority of our largest fund management companies are publicly held. Look at that change. Largely owned by giant financial conglomerates that are managed by businessmen bereft of professional investment training. Think about it. These conglomerates are in the fund business to earn a return on their capital, not a return on your capital as a fund investor. That's what the business is all about. They cannot do justice to both because the more the managers take, the less the investors make. The record is very clear on this point. Over the last decade, using the figures that Jeff Bobroff had done for Fidelity, we've made some few changes. I don't know how well you can read this, but the fund shown, and this is ranking down the 3 columns: first column, second column, third column. Performance rank based on percentile rank against competition across the board, as fair a way as you can really to look at fund performance. The yellow firms at the top of the list are privately held firms. The white firms are conglomerate-owned firms, and the gray firms are publicly held but not owned by conglomerates. You can see that all seven of the top-performing fund complexes were privately held, and 32 of the bottom 34 performers were publicly held. I don't know how to do a correlation on that chart, but I don't think we need to bother. 3, mutual fund returns have fallen dramatically short of market returns, proving the validity of that take-make trade-off. The more we take, the less you make. The gap comes to almost exactly the mutual fund returns from the market, the exactly amount of cost they incur. All those management fees and operating expenses and front-end sales charges amortized for the purposes of these data over 10 years. 12B1 fees, hidden portfolio transaction costs, all in costs that in fact come to something like 2.5% or more, even more per year. How could it be otherwise then? In the past 25 years, for example, the average equity fund has fallen short from the Standard & Poor's index return by 2.5 percentage points a year, just about the same as those costs, and largely because of those pesky fund costs. Gross return minus cost equals net return. Please don't forget it. Judge Brandeis gave me a great phrase for that. The relentless rules of humble arithmetic, and they apply to the mutual fund industry as well as every other industry around. A return of 10% I should say, in a 12.5% market is obviously a shocking gap, but the reality is much, much, much worse than that. As a marketing business versus an investment profession, we bring out these new funds based on the choices of the day and draw in the investing public often at exactly the wrong time. Call it the timing penalty, and I call it the selection penalty. Together, the average fund investor lags the average fund by nearly another 3%. That's actually 2.7%. leaving the investor with a net return of just 7.3% a year, compounded to 4,820 compared to 17,000, or 28% of the market's return. But don't forget that those are nominal returns. They have to further reduce them to a real return of about 4% after we take a 3.3% inflation rate out. When compounded over this grand 25-year era for investing, the average fund investor has captured 22% of the market's real after-tax, pre-tax return. I'm not kidding. You can see it in this chart. $1,000 investing in a simple index fund, it happens to be ours, produced a net profit after inflation but before taxes of $7,620, to which I say, hooray for the magic of compounding returns. But for the average fund investor, the real profit came to $1,670, one-fifth as much, to which I say, boo to the tyranny of compounding cost, which overwhelm the magic of compounding returns. If we adjusted those figures for taxes, and funds are horrendously tax inefficient, it would get even worse. These are not mere abstractions. These are the differences between a secure retirement and a need to depend on a Social Security system that is itself deeply troubled. The opportunity costs that you see in that chart given up by fund owners are enormous. And if future returns are not 12.5%, think about this for a minute, but more like 7.5% on equities in nominal terms, and I think that's not a bad number. Seems to be at this time a sign of a consensus return. The after-tax, real after-cost, after-tax real returns of the typical mutual fund investor in that environment would be about zero. Do the math. I won't do it for you. Number 4, soaring costs in this industry. If fund assets have burgeoned during this great bull market, the greatest bull market in history, costs borne by fund owners have incredibly increased at an even faster rate than assets have grown. From 1980 to 2005, for example, as assets soared from $45 billion to over $4 trillion, the expense ratio, the average equity fund, actually rose from 0.94% to 156. 66% increase. And a lot of people want to use an asset-weighted basis. Fair enough. We do that too. It rose from 64 to 92%, 0.92%, or by a mere 44%. The staggering economies that I, above all people, know exist in the field of money management fail to materialize, as total equity fund expenses rose in this period from $280 million a year to $37 billion a year, 130 times, 129 times over. How such a pattern could suggest there is price competition, other perhaps than the competition to raise prices, in the mutual fund field is simply beyond my comprehension. But it was not always so, and this is an important point. Back in the old days, when I attributed more of a professional cast to this industry, when industry assets rose 4 times over during the 1950s, my first decade essentially in the business, from $2.5 billion in assets to $10 billion, not very big numbers, the expense ratios of the 8 largest funds actually dropped by 20%, as you can see in that chart in the first cycle there over at the left, from 0.60 of 1%, think of that, 0.60, to 0.48 of 1%. And I don't think today you can find a single fund in the mutual fund industry outside of Vanguard that is lower than 48. Well, you can probably find 1 or 2 stray little rabbits out there, but not very many. Today, the expense ratios of that original group of funds, and this is a micro view instead of the macro view, I think it's very helpful, average 1.02%. Excluding Vanguard's Wellington Fund, there in the third yellow, the second yellow line, whose ratio dropped from 0.60 to 0.32% for the full period, dropped by 22%, 32% from 1950. And it's worth thinking about what that extraordinary exception means. You ought to have that in your mind. The expense ratio of the remaining funds averages 112%, 1.12% compared to 0.48 in 1960. Even as fees paid to their managers have soared, however, managers continue to offer their services to non-mutual fund clients at a tiny, tiny fraction of what they charge the funds they control. 3 large managers, these are the only data I've been able to come up with, but CalPERS reports this, for example, charged CalPERS a total together of $1.7 million in, I think the year was 2003, it's not on there, most recent data I could get, totaled $1.7 million for managing $2.1 billion of assets, or 8 basis points, while the manager's 3 funds with comparable objectives paid $167 million for managing $36 billion, 61 basis points. I'm not sure that dollars aren't a much better measure when you get out into this area than basis points are, by the way. So that nearly 8-fold disparity in fee rates and that gross 98-fold disparity in fee dollars hardly suggests, as the Investment Company Institute is constantly assuring the world, quote, the interests of mutual fund managers are well aligned with the interest of mutual fund owners, end ICI quote. Number 5, the rise of short-termism. To make matters worse, institutional money management used to be what we call an own-a-stock industry. When I came into it, we held an average stock for 6 years. During my first 15 years in this business, never much more, never much less. We became a rent-a-stock industry, and we now hold stock for a single year or even less. Leaving aside for the moment, 1, the unwisdom of that strategy, high turnover strategy. 2, the inevitable uncertainty surrounding the returns achieved by funds with such fragile investment bearings. And 3, the tendency of short-term focus to increase risk, portfolio volatility. Such a strategy is expensive. When high turnover costs are combined with the industry's high fees and high operating costs, the achievement of superior returns is almost out of reach. For example, take a look at the figures. This just happens to be the last decade. We've taken the 4 equity fund cost quartiles and compared their gross returns, subtracted their costs, including turnover cost, to get the net return, actually the reported net return. We've taken their risks, we've gotten the risk-adjusted return, and looked at the growth of a dollar. Those numbers do not happen to include sales charges, so the cost would be somewhat higher pretty much across the board. The lower cost quartile outperformed the high cost quartile by 30% a year in net return and delivered, they assumed 34% less risk, think about that, and therefore delivered an annual advantage of almost 50% in risk-adjusted annual return. Compounded over a decade, the advantage to the funds with lower costs, a 207% profit versus a profit for 118% for the high-cost quartile, came to an enhancement of capital of fully 75%. You're talking almost about the difference between a double in your money at 118 and a triple at 207. Note that before, interestingly enough, all of those costs, the manager's returns from quartile to quartile were very similar, more or less 12.5% a year. The relentless rules of humble arithmetic strike again. 6, and my last point, has resulted from this short-termism, I think in part, the failure to honor the responsibilities of corporate ownership. Even as direct holdings of stock by individuals were replaced by institutional ownership, these agents, intermediaries, beset by conflicts of interest, placed their own interests ahead of the interest of their principals. Bad way to do it. What is more, these agents were owners in names only. As investors, owners must honor the rights and exercise the responsibilities of corporate governance. But as speculators, renters who merely trade stocks, they could hardly care less, and you could argue properly so. But if the owners of corporate America don't give a damn about the triumph of managers' capitalism there, the question I raised in the book, who on earth should? We have, as the economists would say, a very serious agency problem. Led by the mutual fund industry, which now owns 28% of all stocks, by far the largest block, institutional owners have risen to power over corporate America that is theoretically beyond challenge. Even as these owners seem to have ignored the gross excesses of corporate America, excesses of corporate America in the recent era, including all that CEO compensation, all that financial engineering, and all that flawed governance, just to begin the list. They've been virtually absent, mutual fund managers, from legal and regulatory processes aimed at reforming the following system. Consider this astonishing, truly astonishing lack of participation by fund managers. No mutual fund firm, as far as I know, has ever sponsored a proxy resolution that was opposed by a board of directors or management. No mutual fund manager testified before Congress about the most important piece of public legislation in the last public company legislation in the last 50 years, Sarbanes-Oxley. No large fund manager demanded more substantial access to corporate proxies when that SEC proposal came along, and a few even argued for more stringent limitations on that proposed access, but the vast majority did not even take the trouble to comment. No fund manager, as far as I know, urged the FASB to get on with the job of requiring stock options to be expensed. No senior mutual fund executive, as far as I can tell, has spoken out on the subject of the rights and responsibilities of either corporate shareholders or mutual fund shareholders. And the only fund manager comments submitted in the recent SEC proposal designed to enhance disclosure of executive compensation was made by a fund group controlled by a labor union, and there you have it. What explains this silence? Either our industry leaders have no opinions on these issues, which is hard to imagine, or they have opinions and will not express them. After all, we do manage all that corporate pension and 401k money. We deny there's any conflict, just for the record. There's no conflict there according to the industry. You can decide that for yourself. But it's time, I think, for us to honor our own responsibilities and demand that fund managers exercise their corporate citizenship in the interest of the fund shareholders and interest, for that matter, in our economy and our society, whom they are duty-bound to serve. Well, the fund shareholders, they're duty-bound to serve. Obviously, I've expressed here serious concerns about the mutual fund industry on many levels, by way of summary. Industry structure, unsatisfactory investment results, excessive cost, focus on speculation over investment, inadequate exercise of the rights and responsibilities of corporate governance. But they all come down to that single principle I mentioned at the outset. Mutual funds must be organized, operated, and managed in the interest of the shareholders, just as the 40 Act requires. If the national public, and I'm quoting here from the preamble to the Act, the national public interest and the interest of investors demands, as it did in 1940, such a policy for a $450 million industry, God knows that goal should not be compromised in 2006 when the industry oversees $10 trillion of other people's money. Within the industry, I know of precious few leaders who agree with the critique I've given you this morning. They don't disagree with it. I've never heard any negatives on it, but they certainly don't agree with it. And when we venture beyond our parochial confines, however, the confines of the financial business and the mutual fund industry, some of the most objective, integrity-laden, and successful investors in the world share my concern. David Swenson, manager of the Yale Endowment Fund, describes the colossal failure of the mutual fund industry, resulting from its systematic exploitation of individual investors. And David is no hellraiser, as funds extract enormous sums in investors in exchange for providing a shocking disservice. Excessive management fees take their toll, and manager profits dominate fiduciary responsibility. His conclusion, of course, invest in low-turnover, passively managed index funds, and stay away from profit-driven investment management organizations. And this is a man with the nth degree of credibility, as is Jack Meyer, successful giant who tripled the Harvard Endowment Fund assets from $8 billion to $27 billion. Most people think, I'm quoting from Jack Meyer, they can find managers who can outperform, but most people are wrong. 85% to 90% of managers fail to match their benchmarks. Because managers have fees, continuing the quote, incur transaction costs, you know that in the aggregate they are deleting value, just what I showed you, take versus make. The investment business, he concludes, is a giant scam. What to do? Mr. Meyer says, get diversified, keep your fees low, invest for the long term, avoid the most hype but expensive funds in favor of low-cost index funds. No doubt about it, he concludes. What about Warren Buffett, who needs no introduction here? Fund management companies have followed policies that hurt the owners of funds they managed, while simultaneously boosting the fees of the managers, trampling the interest of fund shareholders in an appalling manner. This is not Bogle, this is Buffett. The blatant wrongdoing that has occurred has betrayed the trust of millions of fund shareholders. And this is true, hundreds of industry insiders had to know what was going on. All you had to do was read the redemption ratios reported by the Investment Company Institute, yet none publicly said a word. We urge, closing the Buffett quote, fund directors to decide whether their job is to work for owners or for managers. And finally, we will go to the conservative Wall Street Journal, Holman Jenkins. Will fund customers keep supporting the enormous overhead required to sustain ineffectual, unproductive stock picking across an array of thousands of individual funds devoted to every investing style and investor economic sector, or regional subgroup that some marketing idiot can dream up? Not likely. A brutal shakeout is coming, says Mr. Jenkins, and one of its revelations, concluding his quote, will be that stock picking is a grossly overrated piece of the puzzle, and that cost control is what distinguishes a competitive firm from an uncompetitive one. There is, of course, another point of view. Recent paper, Federal Reserve Economist, entitled Mutual Funds, has a curious title, Temporary Problem or Permanent Morass. The paper argues that despite the obvious conflicts of interest between fund owners and fund managers, there is, and I'm quoting this remarkable paper here, one and only one reasonable objective for a fund manager: to maximize the manager's own profit. But think about that. The record is clear that the achievement of maximization, of profit maximization, comes at the direct expense of the mutual fund shareholders. Presumably satisfied with this outcome, the author, Paul Attack, now argues in the recent Wall Street Journal op-ed, there's, quote, at least reason to consider removing fund board oversights of fees and even contemplate eliminating fund boards. That sounds like a lot of progress. But if we're bound by the public interest and the interest of investors, as the Act says, it is simply unacceptable that mutual funds should continue to be mired in any morass, let alone a permanent morass, that puts the interest of managers ahead of the interest of shareholders, even for a moment, let alone permanently. It's time to resolve the profound conflicts of interest that suffuse this industry and resolve them in favor of the fund owners who have put their own capital at risk and expect their trustees to act exclusively in their interest. Over the past 2 decades, of course, the SEC has adopted many new regulations, but too many, indeed I would argue well over the vast majority of them, have been, however well-intended and however necessary, focused on what I would call fairly narrow technical areas: money market fund valuations, disclosure of director holdings or limited disclosure of director holdings, and reporting of complex wide directors' fees. But no regulations were on the books that could have ever precluded the more subtle forms of wrongdoing. As a result, we witnessed the industry's failure to serve investors in the market timing abuses, the performance advertising and aggressive marketing of highly speculative and narrowly focused funds, the failure in many cases to provide volume discounts to eligible fund investors, all of these pay-to-play schemes surrounding brokerage commissions, and the grossly excessive fees paid by fund managers to the funds they controlled. The scandal, it turns out, is not what is illegal. The scandal is what is legal. And the mutual fund scandals were simply an eye into that. They were not the most important part of it, but great to get the spotlight on them. Some of these problems, of course, are beyond regulation, but the fee issue was not. And I believe the SEC staff can be subject to criticism for what might be described as its benign neglect in this area. Why do I say that? Because I turn the clock back exactly 40 years to review the Commission's position in public policy implications of investment company growth in 1966. I believe we have one of its authors right here. When the SEC vigorously recommended legislative changes presciently designed to restore a better balance of interest between shareholders and managers all those years ago, 40 years ago, after they considered the burgeoning level of fund fees, then at an annual rate of $134 million, the effective control that advisors hold over their funds, and the absence of competitive pressure, I'm quoting from public PPI, the limitations of disclosure, the ineffectiveness of shareholder voting rights, and the obstacles to effective action by independent directors, the SEC recommended the adoption of, quote, a statutory standard of reasonableness, a basic fiduciary standard that would make it clear that those who derive benefits from their fiduciary relationships with investment companies cannot charge more for their services than if they were dealing with them at arm's length. Such a standard, continuing the quote here, does not resolve the problems in management compensation that exist, the Commission added. Then more sweeping steps might deserve to be considered. The industry, of course, fought that battle, and as we now know, won it against the reasonableness standard, allowing fund expenses to soar to the astonishing levels that I cited earlier, and costing funds extra tens of billions of dollars year after year. Today's annual fund operating expenses don't run to $134 million anymore. They run, as you have seen, to about $80 billion. Yet even now, 4 full decades later, quote, more sweeping steps have yet to be considered. I think it is now time for us to consider them, and hope the SEC, I do hope the SEC will do exactly that. I want to interject here a couple of points that I don't have in my written remarks, and that is how can funds as a group do better for their investors? And I want you to think about this, not just about equity funds, which are 99% of what gets written about the fund industry, well, 98, but about bond funds, and particularly about money market funds, because the identical principles apply in each case, just at different levels of obviousness. In money market funds, they're crystal clear. In bond funds, they're very clear. And in equity funds, they're clear over the long run and kind of muddy in the short run. There are two ways funds can do a better job for their shareholders. One, all managers can get better. All managers can move their performance up, so instead of lagging the market by 2.5%, if they all earn 2.5% more, their 2.5% charge will then leave investors equal to the market instead of falling behind. You all can decide yourself whether we live in a Lake Wobegon where all of our managers will be above average and well above average or not. I guess my opinion is probably clear by the way I phrase it. There is one other way to improve the returns of fund investors, and that is to slash industry costs. Reduce the take that managers and intermediaries and brokers draw from the mutual fund industry and financial advisors, and then the investors will make more when we do that. I think it's pretty obvious that only the latter one of those two things is even remotely possible, and it is remotely possible. So put me on the side of those, this will I'm sure astonish you, that believe that it's time for change in the mutual fund industry. We have to rebalance that scale on which the respective interests of fund managers and fund shareholders are weighed. Despite the express language of the statute that arguably calls for all of the weight on that balance scale to be on the fund side of the fund shareholders, it is the manager's side of that scale that is practically touching the ground. So to get the preponderance of weight where it begins, where it belongs on the shareholder's side, we need the Commission to press on its mission, now alas under serious legal challenge by industry, some firms in the industry at least, to mandate an independent fund chairman, a supermajority of fund directors, and I want to say parenthetically that I don't know why we shouldn't have even 100% of the fund directors be independent. Management companies, why would they be entitled, given their obvious conflict of interest, to any representation? And in fact, at Vanguard, none of our external managers are represented without apparent harm to our fund shareholders. And three, the empowerment of and implicit encouragement for fund boards to retain a staff or independent consultants to provide objective information to the board, just as Peter outlined earlier, my idea on that. We need Congress also to take action and legislate a federal standard that requires that, quote, fund directors have a fiduciary duty to assure that, going to the present formulation, that funds are organized, operated, and managed to the interest of their shareholders rather than the interest of their advisors and distributors. This principle should be fortified with appropriate language that establishes clear guidelines for care, oversight, and loyalty by directors. Taken together, these changes would at last allow independent directors to become ferocious advocates for the rights and interests of fund shareholders they represent, at last becoming the fiduciaries that they are supposed to be under traditional laws of trusteeship. Alternatively, and perhaps even more desirably, investors must at last consider, well, more sweeping steps. One step could call for a radical restructuring, resulting in the mutualization of at least part of the mutual fund industry, in which the large fund families would run themselves, and the huge profits now earned by external managers would be returned to the fund shareholders. Such truly mutual firms wouldn't need to waste money on costly marketing campaigns designed to bring in new investors at the expense of existing investors. And with lower costs, they could either produce higher returns or assume lower risks, or some combination of the two. The benefits available to fund shareholders through such a mutual structure are not only obvious, but they have in fact been demonstrated in the real world by the industry's lone mutual firm. Please forgive me for the bragging that is about to follow, but the record happens to be crystal clear. Soon to complete our 32nd year, Vanguard has consistently, remember the standards of the Act, organized solid funds, operated them at rock bottom costs, and managed them to achieve superior shareholder returns. Those are the three standards of the Act, and have earned asset growth that has brought the firm to the very top of the mutual fund industry. Look at this chart. The Vanguard market share has increased by 9.2%. Capitals has increased by 7.5%. Fidelity's by, it looks like, 3.4%. And very few other firms have a positive increase in market share, and the negatives go right down the chart. It's amazing to see that. Despite that success on the terms that I've mentioned, solid funds, rock bottom costs, and superior returns, we have yet to find our first follower. And what makes that tragic is when I chose the name Vanguard, I chose it because it meant leader in a new trend. So it's pretty pathetic. We have yet to find our first follower 32 later. You might all ask yourself why, and we can talk about that in the question period. But if Congress, on the other hand, acts to impose on fund directors the fiduciary duties that many of us believe they've always held but rarely exercised, I'm not sure that full mutualization should be mandated by law for the large companies. I'm not talking about the smaller companies. As long as advisory firms are owned by managers who act responsibly, who put the shareholders' interests first, who make manifest their dedication to that proposition in their actions, for example, limiting asset size, limiting fees, limiting market activities, focusing on long-term investment strategies, providing superior service to their shareholders, mutualization does not need to be required. On the other hand, when a fund complex reaches a certain size or a certain age, when it's become more business than profession, it is high time to demand that mutualization at least be placed on the board agenda and honestly and objectively considered. It won't easily be done, of course, and there is literally no one in this entire industry who knows how difficult it is to do and the obstacles that must be overcome to reach that goal, as I am. But if there is a will, there will, I can assure you, be a way. One way to begin to strengthen the power of fund directors would be that funds employ their own officers. Today, of course, they're generally filled and paid by management company executives and assume full responsibility. This is an interesting thought that I haven't seen broached anywhere else. Take responsibility for all of their administrative activities, fund accounting, shareholder record keeping, legal and regulatory compliance, all those sort of very vaguely boring things that must be done well, but still leave to the external manager, today's mutual fund manager, full responsibility for all investment management and marketing and distribution activities. Under this structure, the funds would then have at last the real, as compared to the illusory, freedom to deal with their advisor and distributor at arm's length, fund by fund basis, with a small operations staff to provide independent and objective information on the performance and cost of those marketing and management services. It may surprise you to know that this was precisely the basis on which Vanguard began, just that little administrative function, all those years ago, 1974-75. We did take over distribution when we converted from load to no load a few years later, but to this day, it works, and we continue to use external advisors for nearly all of our actively managed equity funds. So don't disregard that step in the power to transmit to the board. Regardless of what structure we decide on, a truly mutual form or an improved conventional form or this kind of hybrid form I've just described, public policy must move in the direction of assuring that funds are operated on a basis that assures that the interests of fund shareholders holds sway over the interests of fund managers, just as the 40 Act demands. But that's not the only reason. The fact is that such a change will at last enable the industry to enhance economic value for its 95 million shareholders, striving to earn for them their fair share, no more or less, of whatever returns our financial markets are generous enough to deliver in the years ahead. Standards applicable to mutual fund management and stewardship must never, I repeat, never be confused with standards applicable to the provision of ordinary products and services, using some of the ones that are listed in Ms. Tack's article in the Wall Street Journal: jewelry, toothpaste, beer, oil changing, and plumbing. Those are not the standards for the mutual fund industry. Go out and buy whatever you want there. Enhancing shareholder value for fund investors is the direction that this industry must at last move. It is not a radical idea. It is a logical development that returns us to traditional notions of trusteeship and fiduciary duty that have their basis in English common law going back centuries. A body of law that suggests, I'm even going to beat that the prudent investment of other people's money is a sacred trust. And so it is. Thank you. We're on the same wavelength.
Well, I think now you can see why the Bogle critique is something that has to be taken seriously by any group that is looking at the regulation of mutual funds and the structure of the industry. We're going to have a very interesting discussion here, and to lead it off will be my colleague Bob Lighton. As many of you know, Bob is a Vice President for Research and Policy at the Kaufman Foundation in Kansas City and a Senior Fellow in Economic Studies at the Brookings Institution. He was formerly Vice President and Director of Economic Studies at Brookings and is currently co-director of the AEI Brookings Joint Center on Regulatory Studies. He's an economist, an attorney, he's practiced law, and he's taught banking at the Yale Law School. Bob is the author and co-author of numerous books, and he's written many articles on financial institutions. He and I actually have collaborated on a couple of those. He's formerly the Associate Director of the Office of Management and Budget, Deputy Assistant Attorney General in the Antitrust Division of the Justice Department, and a regulatory specialist for the President's Council of Economic Advisors. It's really a pleasure to welcome Bob. After Bob talks, I'm going to introduce Jeff Bobroff. I'm going to introduce John Ray. They will have a chance to talk. Then all of you will have an opportunity, we hope, to ask questions of Jack Bogle or any of the other speakers. And I hope you'll take notes on what you are thinking about in the way of questions so that you'll have plenty of them when we open this discussion. Thanks. Robert?
Thank you, Peter. First, I want to thank Jack for an outstanding talk, and we are privileged that he made time to come and talk to us. So we want to thank you. Now, I'm going to introduce several questions, probably more in the nature of piling on. And Jack, I don't expect you to answer every single one of these. You may not have time. But I'm going to be advancing these questions largely from what I would call a devil's advocate point of view, because both Peter and I are legitimately in the mode of trying to inquire about what is the best approach for regulating mutual funds and assuring investors that they can cost-effectively diversify their assets. And we don't have answers to these questions, and so do not take these questions as representative of my views. They're just questions. So the first question actually proceeds from a premise that I want to make clear. A lot of you here and maybe in the television audience may not understand a basic premise of what Jack was talking about. And frankly, to be honest with you, I didn't either until about a couple of years ago. And that is, the mutual fund industry is very unusual. You have funds that you invest in, whether you buy Vanguard or whether you buy Fidelity or any of the other names that are on that list, and you're a shareholder in that fund. There is a separate management company that the fund hires to manage the money that's in the fund. There is an overlap, and this is why Jack has been so critical of the industry. There's an overlap between the people who run the fund company and the people who are on the management company. In fact, traditionally, the people in the management company organize the funds. And so if you have an identity of people on both sides of the fence, Jack has long raised in his writings, don't you have an inherent conflict of interest with essentially one company hiring another, but the other created the first company? That is what has led to Vanguard saying, well, we'll resolve this paradox or this conflict by internalizing the functions of the management company. So essentially the story of Vanguard is a story where Vanguard took over the management company. It took them many years to do it, but eventually Jack was able to do this, and he what's called mutualized the management company. So they're, in essence, the management company reports to Vanguard. So Jack has raised in his comments, they're the only company that's done this. And so my first question to Jack is, why hasn't anybody else done this in all these years? The market, and we've got lots of $9 trillion out there of people voting with their feet, has moved in another direction. And unless you assume that $9 trillion of people are vastly stupid, why have they gone to these other funds and not adopted the Vanguard model. There's an analog in the insurance industry, by the way. We have insurers who are mutuals, who are owned by their policyholders, and then we have insurers that are for-profit stock companies. They exist side by side. We have an industry in mutual funds which is parallel to that, except we only have one company that's a mutual fund. Why the exception? Second question. The question is, really, if there is such, assuming there is such an overcharge or excess fees that Jack has persuasively laid out, why is it that the independent directors already have not been able to make some dent in this problem? It's only recently, for example, that the SEC has talked about moving toward more independent directors, but in fact, as I understand it, a number of funds, many funds, have already moved to an independent director model. Many of them, in fact, have a majority of their directors are independent, and yet we have this persistence of these so-called excess fees that Jack's talked about. Why hasn't this situation been corrected? And if it hasn't been corrected by independent directors, then why do you believe that moving to 100% independent directors is going to solve the problem? Third question. There's been a lot of criticism of the mutual fund industry for the way in which fees are disclosed. For the average investor, to be perfectly honest with you, it's very complicated. I mean, we had mentioned here earlier something called 12b-1 fees, which frankly, I suspect not many people understand what they are. They're expenses that are incurred for distributing funds, which are paid out of the fund corpus. And actually, an idea that I learned that essentially Vanguard pioneered. Vanguard went to the SEC, as I understand it, and asked for an exemption that created 12b-1 that apparently led to the monster that Jack has later criticized. We have an industry now that relies heavily on 12b-1. But in any event, the fee structure in this industry is complicated. And so why isn't a solution to a lot of these problems a vastly simplified set of disclosures related to fees, maybe an all lump sum one fee structure so that people can easily compare them, and then, as in other industries, let the market decide where the money goes. So why isn't simplified disclosure an answer to this problem? Fourth issue. Jack talked about having a congressional change, a new statute that would impose a fiduciary duty on the fund manager, or on the fund directors, as I take it, to act in the interest of their shareholders. Now, my understanding is existing law already requires that. And in fact, we have, again, in my understanding, a lot of litigation under what's called 36B of the Act, where essentially we have litigants who are claiming that directors are not living up to their fiduciary duties as they are under current law. This litigation is expensive. So the question is, why do we need an additional statute? And if we do have an additional statute that somehow goes beyond existing law, are you not concerned that, in essence, we're going to have judicial intrusion into not only setting fees, but also management styles? I mean, I can envision lots of litigation under a broadly worded statute that basically has judges deciding what kinds of investment philosophies funds ought to be performing. And my final question, Peter, and I am going to observe the time limit, my final question is, Jack has a long critique about the failures of mutual fund companies to vote their proxies. In other words, they are not exercising voice. They're just simply staying quiet. And yet he has argued, and I think very persuasively, because I follow this advice in my own personal affairs, I've gone to indexing, all right? But if investors go to indexing, there's no incentive for a fund, an index fund, to talk up. Because an index fund, you're just buying the market. So why should we expect the directors or the officers of an index fund, which is just buying the market, to essentially voice their views on all these proxy proposals? That, in essence, isn't their business. They're just buying the market. So hopefully that's food for thought. Jack, I don't expect to answer every question, but at least that gets a few of the issues out on the table. Again, thank you very much.
All right, our first commenter will be Jeff Bobroff. Jeff has held a number of positions in the investment management industry spanning 3 decades. Before establishing his consulting business, which is called Bobroff Consulting, which he did in October 1993, he served as Senior Vice President of Lipper Analytical Services, overseeing their Denver office, and before that he held positions as Executive Vice President of Integrated Resources, where he was responsible for money management, broker-dealer activities, and other operations of the firm. And he was the Executive Vice President also of J&W Seligman & Co., where he was responsible also for operations and financial affairs. Jeff, do you want to speak from there? Okay, we'll remove the podium then. Please welcome Jeff Bobroff.
Thank you. I'm not going to try in any way to address all the different issues that Jack raised in his presentation, but just raise some issues that I think are general concerns for some of the discussion that I heard this morning and read in his book. And from a practical standpoint, I believe that as an industry, we have gotten a bum rap in a variety of ways. And I'm not here to sit and defend the industry, but to tell you very candidly, market scandal or the late trading and market timing issues seemingly has swept up so many issues as being scandal related. And it troubles me as a practitioner in the business to see all of the things that are somehow, should I say, draped with this concern that somehow this industry has lost its way. And as a generalization, yes, we've had problems. And as a generalization, yes, people have engaged in conduct that is inappropriate. But at the same time, there are significant numbers in this industry, members of the industry, that have not strayed and have delivered on their promise to investors. So it just troubles me to hear the generalization that this industry has lost its way, that this industry has been consumed by the excesses of the 90s. That's not to say that certain members have been affected by it, but the rest of the industry as a whole, I believe, can stand tall and show that it has delivered on its promise to investors. Investor returns are quite good across the industry. Mutual funds, if they were not a choice investment by individuals, wouldn't be at the position that Jack indicated earlier today at $12 or $10 trillion. From a business standpoint, that's a recognition that investors have found that they are getting value in their returns. Now, one might argue that they may not fully understand what it is that they're doing, but the point being is that as an industry, this is an industry that has responded to change. It's a highly competitive industry. Back in the 50s, as Jack described the inception, the industry was very simple. It had basically two products. We had a domestic equity fund, and we had a bond fund. The domestic equity fund was what I would call as a go-anywhere fund. It basically could go large, mid, small to the extent that they existed, international to the extent that they could engage in such activity. And the same thing is true of fixed income. But as time went on, this industry decided to embark upon some variations on the theme, and today it's an industry that consists of, and I don't recall what the actual number is, but well in excess of 10,000 individual mutual funds that span every category imaginable from an investment standpoint. I was amazed that there's a big push, Jack, right now by several groups to do, should I say, leveraged index funds. I mean, we've taken the basic index concept and taken it to an extreme. That's not to say that the core of the industry, the heart of the industry, still is very focused on providing quality investment returns to investors. What we've also seen in recent periods is an explosion of a concept called fund-to-funds. Vanguard being a leader here when they went and got their exemptions through the SEC to allow them to create what is called the Vanguard Star Fund. Today, the star funds, or the asset allocation funds and balance funds, are the largest single category of investment choice within our industry. And that, to me, is an amazing concept of what transition has occurred as a basic business. We have been living with transparency issues for the last 20 years, 30 years. We've had this debate and discussion about full disclosure of fees and expenses. If we go back and look at the history, this little table that appears in the front of the prospectus, this fee and expense table, has gone through many evolutions or revisions by the SEC. And each time it gets enhanced. I will tell you that I think bottom line, though, investors are most interested in one thing, net return to the investor, which does take into account what those expenses are. And investors are driven by the net return, not necessarily whether or not this fund is expensive or not. They're focusing on what the return historically has been. Since as an industry we can't speak in terms of future returns, we can only speak in terms of historical returns. Transparency has been expanded over the years in a variety of ways, and Jack has enumerated some of them in his earlier discussion. Whether or not they're necessarily as far-reaching as some people would like, I would say to you today, of almost any investment that's out there, a mutual fund shareholder gets more information than they get from any other investment that they may be making today. But all that aside, this is an industry that is still driven by net return. And if you go back and look at that chart, the top three organizations, Vanguard, American Funds, and Fidelity, have surprisingly among the lowest expenses in the industry. Vanguard being probably the lowest, and Fidelity and American Funds not far behind. What does that tell us? It tells us that return is influenced by net expenses. And obviously investors are driven or follow or seek return. So if there's a message that the industry should be listening to and looking to is where is the money going? Those three organizations today have 30% of the industry's assets. That's a remarkable thought because if you go back, as Jack did, to 1981, those three organizations had 12% of the industry's assets. So what we've seen is a transition that has occurred in a robust return environment to a return environment that is clearly less than robust from what it was in the 90s. However, it's interesting to me in tracking this industry, and I'm a student of it and have been involved since '69, is the fact that things evolve and change, but in reality, we haven't seen significance. This is an entrepreneurial business. When you look at the business, in 1991, some 15 years ago, the top 30 fund companies had 72% of the industry's assets. Today, the top 30 companies have 75% of the industry's assets. Now, mind you, the industry has grown from about $1 trillion plus in 91 to the $10 trillion today. What does that tell me? What does that show? Is that it's a diverse industry. Is that you would expect in a maturing industry that concentration would bring all the assets to the top. It hasn't. It has allowed people to come into this business that weren't in the business before. And that to me is a marvelous aspect of it, is that this is a unique business that allows things to occur in a variety of different ways. The other element is that mutual funds cross individual portfolios of all net worths. Recent analysis that I've done with another consultant shows that mutual funds play a significant part in the retail, the affluent, and the high net worth marketplace. What does that tell me? Is it tells me that mutual funds are serving and satisfying a need of investors. Clearly those that are in the high net worth marketplace have a lot of choices available to them. Those that are in the affluent marketplace do, but mutual funds still play a significant part. If we look at individual asset holdings, exclusive of the defined contribution market, today over 52% of the $10 trillion, not the mutual fund industry, but the $10 trillion that is owned by individuals, holdings of securities and mutual funds, not in their retirement plans, 52% is in mutual funds. Again, that gives you a sense of the breadth and cross-section of the acceptance of mutual funds as a concept. I mentioned earlier this interesting evolution to the balanced and asset allocation concept. It's the largest single category today of investments selected by individuals. One can blame it on the bear market. One can blame it on a variety of factors or see the roots of it, but in practical terms, we've clearly seen a change. This is an industry that has been accepted and embraced in the retirement plan marketplace. Strategic Insights published a data point, I guess it was last year, which showed that in terms of the period 97 through 2004, the 7 years, in domestic equity funds, 73% of the net inflow came from retirement-related plans. And 61% of the industry's assets in those funds is retirement-related. And when I say retirement-related, I'm referring to these defined contribution plans as well as individual retirement accounts. So it's an industry that has clearly been benefited by the retirement aspects of our industry. As I mentioned earlier, it's highly competitive, information is so available to investors, whether it's through the internet, whether it's through the newspapers, whether it's through magazines. This is not an issue in which we're playing the three-card Monte in New York where you're trying to find the queen and trying to figure it out. It's there. Now, granted, investors may need some time to do it, but what's interesting, as I think it was mentioned by Peter, is that the overwhelming majority today of investors are now seeking guidance and advice from someone, where they're relying upon a professional to bring to them, one can question that judgment, but that's reality, the best investment choices that are available to that professional to provide to that customer. So from a business standpoint, we've seen a change in emphasis. Investors are no longer self-directed in the numbers that they were in the 90s. They clearly are seeking guidance and advice. Again, you can blame it on the bear market. But to go back to a couple of points that were raised in terms of the concept of expanding the board, or should I say making the board more independent. My consulting business over the last 2 years, 3 years, has changed markedly. Today, over 50%, and in reality this year it probably will be 75% of my time will be spent in the boardroom with boards. Jack has indicated that the board should be seeking a staff of its own. Well, the SEC mandated a chief compliance officer requirement, which is the beginnings of a staff of its own. In addition, the SEC, in promulgating some rules on disclosure, has indicated and urged boards to hire their own independent consultants to assist them. And I will tell you, based on my own experience, boards are doing that. Boards are looking at a variety of issues. One of the questions is raised again in Jack's numbers in terms of the expense component. Lipper, which does tabulations of the industry, shows that in 2003, roughly 300 classes, because it didn't break it down by funds, so it's hard to determine, but roughly 300 had their fees lowered in 2003. In 2004, over 1,700 had their fees lowered by their board or by management's own desires, or by the regulators, being the era of Mr. Spitzer. And 2005, the preliminary number was about 1,600. So we clearly have seen a directional change. I will be the first to admit that if we go back and look at the period preceding 2000, what we saw was an upward bias for a variety of reasons in terms of expenses. First, new funds being created in categories that didn't exist before, in which people sought and obtained higher fees based on what was perceived to be the relative market value of those services. But clearly that there has been a sea change. And in my experience with boards, whether or not they're using an independent chair or they have a lead independent director, we're clearly seeing a shift in emphasis and a focus that is very much along the lines that Jack has indicated, which I think has clearly been historically in a variety of organizations, is focused on the interest of shareholders. And so from a business standpoint, I think this industry is evolving. It may not be evolving as rapidly as Jack and other commentators might believe, but clearly a sea change is underway. Thank you.
Thanks very much, Jeff. Our next commentator, discussant, is John Ray. John is a consultant specializing in the mutual fund business. From 1994 to 2004, he served as the chief economist of the investment company institute, ICI. Before joining ICI, he was an assistant director and chief of the capital markets section at the Federal Reserve Board. Before that, he was a professor of economics and chair of the economics department at Oklahoma State University and a financial consultant to the Federal Reserve Bank of Kansas City. John, welcome to the podium.
All right, thank you, Peter. Appreciate your inviting me here today. I think Jack's, I may not appreciate it as much later on, but Jack's a very tough act to follow. And in fact, I find it very interesting that his stature has now increased to the point where all we have to do is refer to the Bogle critique, and you really don't have to say anything else, Jack. We're quite aware of what all that means.
40 minutes.
Well, I wish it had been a little shorter myself. But I do want to say that I'm glad to have an opportunity to comment on it. Jack's long and distinguished career in the mutual fund business, which does include founding one of the most innovative and most respected names in the business, does require us to pay close attention to his views on the mutual fund industry. This morning, I would like to begin with a brief summary of Jack's assessment of the fund industry based upon my reading of his new book, The Battle for the Soul of Capitalism. I'll follow that with a discussion of two shortcomings in his analysis. To be specific, I will argue that his analysis provides no explanation for the growth of the fund industry, and that his analysis is inconsistent with the industry's competitive market structure. In summarizing Jack's view of the fund business, I think it's fair to say that he does not like what he sees. One of his favorite phrases is the industry has lost its way, not just recently, but over the past 50 years. By this, Jack means that fund advisors or fund management companies have turned their backs on fund shareholders in favor of their own interest. As a result, Jack concludes that mutual funds are overpriced, underperforming investments that have served mutual fund owners poorly while enriching advisors and management companies. The root of the problem, in Jack's view, is a flawed business organization coupled with weak corporate governance. Shareholders in a mutual fund do not directly or indirectly own their fund's advisory or management company. Thus, the advisor is not answerable to fund shareholders, but rather to the owners of the advisory company. To make matters worse, advisors dominate mutual fund boards, which consequently have been ineffective in forcing advisors to place shareholders' interests before their own. To elevate shareholders' interests to the top priority, Jack supports empowering independent directors by requiring a supermajority of independent directors and by requiring fund boards to be chaired by an independent director. In addition, Jack has called for federal legislation making fund directors fiduciaries and would like to see fund boards retain their own staff. For two reasons, I do not agree with Jack that the fund industry has lost its way or that it has generally harmed fund shareholders. One reason is that the extraordinary growth in assets and ownership in mutual funds over the past 50 years suggests that fund investors have to be receiving something of value from their investments. The second reason is that the fund industry has a competitive market structure and is well known competition does not reduce consumer welfare. Let me elaborate on these two problems with Jack's analysis, starting with the growth of the industry. Mutual funds have become a large and significant industry. With over $9 trillion in assets, the fund industry is today just a shade smaller than the banking sector, which is the largest group of financial institutions in the U.S. For comparison, fund assets in 1980 were a mere $135 billion, or just 1.5% of their current level. In 1980, less than 5 million households owned mutual funds. Today, 54 million households, nearly 1 out of every 2 U.S. households, owns mutual funds. And these 54 million households contain 91 million individual investors. It is hard to believe that this expansion in assets and ownership could have occurred if mutual funds are, in fact, the decidedly inferior service that Jack says they are. Mutual funds, after all, are not a necessity, nor are they the only means that individuals have to invest in stocks or bonds. Individuals can buy them directly or through separately managed accounts or in personal portfolio programs. Other alternative investors for individuals include bank deposits, deferred annuities, savings bonds, life insurance, REITs, common trust, exchange-traded funds, and hedge funds. In defined contribution plans, employers can use collective trusts, guaranteed investment contracts, bank deposits, and separate accounts instead of mutual funds. As the availability of these substitutes suggests, the use of mutual funds is voluntary. And this means that the growth of the fund industry itself has been the result of voluntary transactions, not coercion, government mandate, or necessity. Investing in funds does not take place in the dark, as information on them is widely available. In addition, shareholders receive regular reports on the performance of their funds, and they can terminate the relationship with their mutual funds at any time and for any reason by redeeming their shares. The individuals who have chosen to purchase and own mutual funds typically do not go it alone, but rather invest with the help of third parties or intermediaries. 60% of all fund owners primarily buy funds through their employers, who select a small number of funds and other investments in which participants in defined contribution plans may invest. Those who principally buy funds outside retirement, of those who principally buy funds outside retirement funds, nearly 75% use financial advisors or brokers when investing in mutual funds. Although a large number of fund owners are of modest means, mutual funds are not just for the small investor. The vast majority of wealthy households own funds, and their holdings account for well over half of all the fund assets held by households. I could describe other characteristics of mutual fund owners, but my point should be evident. Shareholder characteristics, combined with voluntary decisions to invest in mutual funds, do not suggest a population that would willingly purchase and hold funds if, as Jack asserts, they are virtually of no value. Indeed, if Jack were right, it would imply that millions of individuals, their financial advisors, and their employers would have been making investment decisions for decades that were inimical to their welfare. In Jack's framework, the willingness of anyone to own mutual funds, much less 91 million individuals, is baffling and mysterious. Let me now turn to my second topic, competition. The fund industry has a competitive market structure, which one would therefore expect to enhance investor welfare. Nonetheless, one important implication of Jack's assessment of the fund industry is that competition hurts investors. Let me briefly review the structure of the industry. Reflecting low barriers to entry and exit, 600 mutual funds currently offer about 600 mutual fund companies currently offer about 8,000 mutual funds to the public. Asset concentration among these companies is low. The big three, Fidelity, Vanguard, and Capital Research, account for about 1/3 of industry assets. Concentration ratios for the top 5, 10, and 25 fund companies have been relatively stable over the past 25 years, although the companies within these categories have changed substantially. Outside the fund industry, there are a large number of potential entrants that include non-fund money managers and domestic and foreign financial institutions, as well as numerous portfolio managers at existing fund companies. As noted above, mutual funds have many close substitutes, and information on virtually every aspect of mutual fund performance is readily available at low cost from mutual funds, regulatory filings, vendors, financial advisors, and the media. Finally, showing cost sensitivity in their investing behavior, mutual fund investors have concentrated their purchases and holdings in low-cost funds. In competitive markets, prices reflect the interplay of supply and demand. Competitive markets ensure that resources are allocated efficiently, that funds are responsive to consumer tastes and preferences, and that long-run profits are not excessive. From this perspective, recent research has shown that the performance of the mutual fund market reflects its competitive nature. For example, several researchers have found that the asset share of fund companies is highly and negatively related to expense ratios. That is, increases in expense ratios reduce a fund's family's share of industry assets. Research has also found that market shares are affected by investment performance and other services. This evidence suggests that competition in the fund market is consistent with enhancing investor welfare, not reducing it, as Jack maintains. It is important to note that in making his case that the mutual fund industry has adversely affected investors, Jack does not rely or point to traditional sources of market failure, such as externalities, natural monopoly, or collusion. Rather, he attributes the adverse effects to the profit-maximizing behavior of fund companies. That is, in Jack's framework, the pursuit of profits leads fund companies to ignore the demands of their customers. His analysis, however, conflicts with the conventional theory of competition, in which the profit-maximizing behavior of producers is part of the process leading to positive outcome for customers. Let me explain how this might work with mutual funds. Fund investors want good performance from their fund investments, which for better or worse, investors evaluate using past returns, net of fund expenses and other costs. As has been widely documented, past performance drives new investments to funds. For their part, fund companies want large and increasing levels of assets because their revenues are tied to assets under management. To attract and retain assets, fund companies strive to achieve high net returns. Thus, the interplay of investor behavior and fund company objectives serves to align the interests of these two groups. In this competitive setting, fund expense ratios are rationalized and constrained. As Jack and countless academics have found, net returns are negatively related to expense ratios. A fund company that might seek to increase revenues by raising fund expense ratios without restraint would adversely affect fund performance and lose assets. Beyond performance, fund investors want a high level of services, such as a variety of fund types, broad distribution, advice packaged with the purchase of fund sales, shares, no-load funds, and access to customer services and representatives, just to name a few. Fund companies that pursue a strategy of accommodating these service demands also gain assets. Thus, from a competitive perspective, the changes that have occurred in the fund industry over the past 50 years are not a mystery or an indication of a failed industry. Rather, the changes reflect the responses of a competitive industry to individuals' demands for stocks and bonds that can be satisfied through mutual funds. Indeed, if the fund industry had not changed, or had remained as it were in 1950 or even 1980, then I would say it would be fair to wonder if the industry had indeed lost its way. In closing, I want to add that it's not my intention to suggest that mutual funds constitute an industry that can do no wrong. The market timing and late trading scandal is sufficient to make that point, but one could expand the list to cover other misdeeds. In this regard, the industry would have been well served to have paid attention to Jack's concern about the slippage in ethical and financial standards. Furthermore, I do not want to imply that the competitive marketplace eliminates the need for fund boards and independent directors. Boards are necessary to help resolve and mitigate conflicts of interest between advisors and funds. Nonetheless, these qualifications do not imply that the fund industry has poorly served its customers for the past 50 years. On the contrary, the industry has responded to changes in market conditions as one would have expected of a competitive industry, and in the process has met its customers' demands.
Great, thank you, Jack. John.
What did I just say?
It's a Jack critique.
Yeah, another Jack
Well,
critique.
his
Okay,
first
well,
name's John, so.
We've had a number of questions for you, Jack, and I'd like to give you an opportunity now to respond to all of those, and then we'll ask the other members of the panel if they want to respond to what Jack has said, and then we'll go to questions from the audience. So, Jack.
Okay, let me just try as many of them as I've been making a lot of notes here, and I kind of wished each time. I think in very round numbers, about 50 things have been set up here that I totally disagree with, and even Bogle can't respond to all 50 in any reasonable way. So let me just reflect on a few things with you. One, we must be, I'll paraphrase John's thoughts, and this is maybe a little bit edgy way to paraphrase them, but I think it's pretty clear. We must be doing something right. We have $10 trillion of other people's money. Well, wait a minute. We grew up in the greatest, longest, and strongest bull market in the recorded history of the human race. 18% a year, an equity fund environment in which $10,000 would grow. If there weren't very many people in the mutual fund industry at the beginning of the period, but when you look back, in which $10,000 would grow to, I think the number is $162,000. You can look back and say that, we were lucky to be in that kind of environment. I would. But the idea that growth in an unprecedented and not to be repeated stock market is not a very strong read on which to rely for the future, for the years ahead. So it's not going to happen. And number two, and this is more on Jeff's point, returns have been good across the industry. Please, where would that come from? I mean, you saw the data. The average common stock fund has lagged the market by 2.5% a year. The average common stock fund investor has lagged the market by 5.2% is the number, 2.5 plus the 2.7 that bad timing and bad selection brings about. I don't see good across the board. But again, as I said in my talk, think for a minute about the nature of the fund industry. It's not just an equity industry. And let me start with money market funds. It is in the cards that money market funds cost will take about 30% of the return available to you in the money market away from you at kind of existing interest rate levels. Go higher, it's a little bit less. At the bottom, some money market funds were quite literally yielding so little that the managers waived the fees so they could produce a 0.5% return or something like that in a probably 1.5 or 2% market. So money market funds, you're giving up, in round numbers, 30% of your returns. In the bond area, this is all in the record. The average bond fund lags the bond market by about 20% per year. You lose 20% of your returns, and that does not count the fact that when you buy a load fund, which is the most common way to buy a bond fund is through a load fund. I'm going to make a point around that in a second, but I haven't even taken account of the fact that your first year's income is eliminated by buying that bond fund. You pay a 5% sales charge and get in round numbers, well, you get about a 4% yield from the average bond fund, because in the 5% market, the average bond fund delivers, guess what? 4% in a 5% market. And then you're talking about the equity market. Well, sure, in a 12.5% market, that was the return for the last 25 years, because we have the bad years that followed those great years. 2.5% is, I guess, 20% of the return goes away. But we're not going to have another 12% market. There's no point in looking back and talking about the past in terms of what's going to be consumed. If you look at a 7.5% market, it might be reasonable. Funds will consume about, at present levels, about 30% of that return. And then if you have the ill grace to look not at that nominal return, but at the real return, the capture of equity market real returns under those circumstances would be about 60% of a 4.5% net return. So we have the fabric, a social fabric of our society here. And if you add bad selections to that number, it gets even worse. So the numbers just don't support that the results have been good. If everyone in the audience would agree that good has something to do with approaching the returns in the market. And independent studies, academic studies, not Bogle's, suggest that over an investment lifetime, you have about a 5% chance of beating the stock market. Not this year, not next year, not 25 years, but over your investment lifetime, which for young people today is 65 years. So when the stock market return is there for the taking, why in God's name would anybody fool around with it? So why are the customers so, quote, dumb, quote? Well, first of all, the customers of most fund companies are not investors. They are brokers and financial advisors. Think about it. Think about the variable annuity business, the worst possible example of, or the best possible example of the conflict I'm speaking of. Look at the ads that say, I've got a great variable annuity for you. How do I know it's great? Because you make 50% of the first year's commissions, and then a trail of 10% a year. They're appealing to the seller and not to the buyer. We have a seller-dominated industry, and we therefore have, I love to use economic phrases, we therefore have informational asymmetry. And that's a nice way of saying that the seller knows what's going on and the buyer doesn't. And the buyer is very short-term oriented. You can always find a fund that is in the past 3 or 4 or 5 years done twice as well as the stock market. You can find, I'm sure, a few that have done 3 times as well. And you can also find the other side of that coin, because on average we're all average. But the brokers focus on what has worked. And we appeal to the fund industry, John, does not ignore customer demand. We love customer demand. Why on earth do you think we created 494 new economy funds, telecommunications, technology, internet funds at the peak of the stock market, and took $600 billion into those funds and lost, even to this day, $300 billion of those investors' money? We appeal, we love to meet demand, but we don't meet demand in the right way. We meet demand on short-term market impact and we have gotten a lot of that, out of that. So I'm bothered with that kind of analysis, greatly bothered with it, because I think it A, looks backward, and B, really ignores some of the things when you get through looking at how fund investors have done compared to how fund investors done. Let me come to the question that Bob raised about where are the other vanguards. Well, this is an industry that was certainly begun on entrepreneurial kind of instincts. People started a fund group, and let's put the best possible face on it. They thought of themselves as trustees, and I know a lot of these people. I actually knew people like Merrill Griswold and Walter Morgan, and some of the old Fidelity, Mr. Johnson Sr. They basically thought of themselves as trustees. In many cases in those days, didn't even have a distribution company of their own. The distribution was done by a completely different firm, eliminating that conflict between marketing and management that I've spoken of so often. So it's an industry that started to work that way and fell away from that. And now the question is, should a structure that seemed eminently reasonable at the beginning be supplanted by a new structure better fitted to the needs of today's investors? The conglomeratization, I don't think anybody in this room would argue that that 70% ownership of the mutual fund industry by conglomerates, those firms, and it's spelled very clearly out of the performance data I showed you, are in business to make money for themselves. That's what people do. I mean, read what they say when they come into the fund business. We aren't getting enough fee-related business, says the Bank of America. And so they say, go out and get fee-related income here from 7% to 15%. And guess what happens? The investment management division knows exactly what to do. They bring in assets. They bring in canary funds. They offer side deals. They do hedge fund trading. They allow market timing at the expense of their long-term shareholders to enrich these short-term hedge funds, which I'm told hedge funds trafficking in mutual fund shares reached a total of 400 hedge funds trafficking in mutual fund market timing. That's an awful lot. That's a number that came out of, at least I read it in the Wall Street Journal, quoting the SEC. And the conglomerate, I want to add this about, we don't know a lot. There's, when I was testifying down at the SEC about the separation, I was, of course, testifying in favor of it, the separation when Chairman Levitt was trying to separate consulting from auditing services, separate the consultants from the auditors because of the conflict of interest there. And one of the commissioners said, well, where's the smoking gun? Where's the evidence that this combination of auditing and consulting services has done any harm? This was, of course, pre-Enron. And even in Enron, we don't have a real smoking gun, as far as I can tell. I mean, the whole case has now been reversed, so I guess we do not have a smoking gun. But I said, there's some times when statistics don't prove what common sense does. And so we're talking about some body of people looking after the interests of the funds. It's interesting in the case of the market scandals, and this is one of the subtle things about a better structure. As I just took a look at the 25 largest mutual fund firms, and 10 of them, 40% of them, not this little tiny thing the industry talks about, 40% of those major firms were involved in the mutual fund scandals. Five of the 20 were not. 5 of the 20 were privately held. Not one was involved in the scandals. The remaining 20 were publicly held or conglomerate-owned, and 10 of them were involved in the scandal. 50% versus 0. That's a statistic that doesn't necessarily prove anything, but gosh, you got to think about whether their interests are the good of the business and the good of the manager or the good of the fund shareholder. Now let me freely concede, of course everybody's doing the best for their fund shareholders. Why would they do otherwise? We're all out there slugging it out to try and get better performance every day. But on average, we're all average. I mean, get a life. I mean, we're all average before cost and below average by the amount of the cost. So we have to recognize that by taking huge amount of cost, not only out of the mutual fund system, and we ultimately will. It's fees and trading and sales commissions and so on. Just have to come out of the system. So let me just see if I can pick up maybe one more, and then I'll ask you to focus on maybe your favorite criticisms that I might not have addressed to. Let me talk about the independent staff. I think you raised this information too, and the information. First, the cost of an independent staff would be trivial. A couple of people there, maybe bright young business school grads or something like that have a way with numbers. And think of what real information would do. Think about this one. Let me give you one simple example. From the beginning of my career, we always talked at our board meetings about redemption rates, which I call an index of shareholder satisfaction. And in the early years of this business, the typical redemption rate for the average fund was around 7% a year. The average mutual fund holding period for a fund shareholder was about, well, what's that, 18 years or something like that. That number started to grow and grow and grow after the go-go era and up to today. And it got up to 43%. That's an average fund holding period of maybe a year and a quarter or a year and a half. I guess 50% would be 2 years, so 43% would be 2+ years, down from 18 years at the beginning. Every fund director who read the annual report would have known what the level of fund redemptions were. If we'd only had the directors have someone say, would you look at our redemption rate for a minute? What would a director of the Alger funds have said when he saw that in, I think the year was in 2001, that the Alger funds had $2 billion of assets, this example is in my book, and they had $8 billion of cash inflow and $8 billion of cash outflow? Would somebody have said with a 400% redemption rate that, why don't we take a look and see if there could be some market timing going on here? We need someone to bring out a lot of information that we don't get in the typical consultant studies. Now, I've seen the Lipper reports, and I find in many respects they're wanting. I'm told, although I have never seen one that I can put my finger on for this, that they ignore Vanguard in their cost comparisons because Vanguard is different. I don't know if that's the case or not. You're damn right Vanguard is different. And I might say on that point, I would never say, think about this for a minute, I would never say that this industry, the mutual fund industry, needed Vanguard. But I would absolutely say that the mutual fund industry and every industry in this country needs a Vanguard. Someone to say, I see what you're doing, I don't think it's good enough, and I'd like to try a different way and may the best strategy win. So you need an outlier. You need, I was going to say a loudmouth, but I'll retract that. You need someone to say there's a different way of doing it, and I think a better way. So a small staff to pick up the important information, not just the fee ratios, but how many dollars are involved in that fee. To do what I call static portfolios. I see you're running a 211% portfolio turnover. Could you tell me the returns that you would have had if the industry had just, if you just held the portfolio at the beginning of the year? The odds happen to even believe the number is 52% that the returns will be better if you do nothing with the portfolio during the year. And let me say then finally the ultimate conflict that we really haven't talked on, although we've tranced around. The reality is that the interest of our financial system and the interest of those whom it is duty-bound to serve are 180 degrees opposed. It's a very serious conflict. Because if you think about it for more than 30 seconds, and I've thought about it for a lot more than 30 seconds, the interest of the investment business out there, mutual fund distribution, stockbrokers, whatever you have, investment bankers, is based on the underlying principle: don't just stand there, do something. Act, trade, respond to Alan Greenspan's later words. Bring out something new, change something, trade something, buy one and sell the other. That is what the investment business does. If they didn't do that, we wouldn't be trading $3 billion of shares of stock every day. It's a business that says, don't just stand there, do something. The evidence is crystal clear that the reverse is the right strategy for the mutual fund investor, the client of the investment industry. Don't do something, just stand there, own the market, and hold it forever.
Thank you, Jack. John, Jeff, do you want to respond in any way to what Jack has just said? And then we'll try to go to the audience.
I had just two quick comments. One with regard to Jack's concern or comment about my view on the fact that we've done a good job from an investment standpoint. And he points to the averages that he says in terms of return. I would suggest to you as an audience, people don't buy averages. They buy individual funds. And an average is nothing more than something that is an arithmetic number. And from a structural standpoint, I would urge you to focus on the fact that who's grown the assets during this period are those that have stronger numbers than the average. So we can't look at averages and reach any full conclusion that something is amiss because people don't buy averages. The other element, and I'll quickly stop here, is that Jack talked about conglomerates, and I would echo his concern about conglomerates. And if you look at the statistics, again back to one of his earlier charts, those pure play firms, and I'll define pure play, are those that are in only the asset management business and not in other businesses, have been able to attract and retain investment talent that has produced above average returns. And isn't it interesting to see that two of the conglomerates, Merrill Lynch has decided to get out of the business and move it to a pure play firm called BlackRock, and our friends at Legg Mason and Smith Barney have restructured themselves, where now Legg Mason is only a pure play asset manager, and the brokerage business has gone over to Smith Barney. So clearly the element is that those that are pure play firms have been able, for whatever reason, to deliver better investment results because of their ability to incentivize, attract, whatever it may be, those members of our community that can produce positive alpha in terms of investment return. So again, abstracts, we can talk in generalizations, but we really do need to come down to specific examples.
John.
Yeah, I'll just say briefly, because I know you want to go on to some of the questions. I'd agree with Jack. The industry needs a vanguard, or needs vanguard. They need people like Jack Bogle who offer criticisms and require us to think and respond to thoughts that aren't in the mainstream. Jack and I are never going to agree, and I do want to add one sort of summary statement here. The way I looked at his work today was to take a look at the big picture, the framework of his analysis, check out the economics and see how that stands with mainstream economic analysis. Let me also say that the way Jack approached it, I think, this morning was to look at a bunch of micro data, elements or aspects of industry performance, and then build his big picture up from there. I just want to say Jack and I would need another 2 hours to thrash out our differences over the charts and the data that he has there too. And those of you who may be persuaded by his presentation, which I will grant you, he's a very effective promoter of his points of view. Those charts have another interpretation. There is another story behind them, and those charts themselves don't necessarily lead to the conclusions that Jack wishes to have you form from them.
Okay, thanks very much. I actually have one question, Jack, that I really would like you to address, because Bob also asked this question, and before we go to the audience, maybe you can, and that is that what you seem to me showing by your critique, and again, I don't want this to suggest that we have any fixed conclusions, Bob and I, about where this study is going, but what it does seem to show is that independent directors are unable to control costs. If costs are rising so fast in relation to assets, where is the evidence that the independent directors are doing what they are supposed to be doing? And yet your idea for reforming this is to give more power to the independent directors. So how do you account for this? It has been, I think, 5-6 years now since independent directors have been a majority of boards. Many of them before that were a majority. Many of them were a supermajority. But I'd like you to address why it is that this change is not occurring.
Or, and let me just supplement, or the flip side is, why aren't you driven to the conclusion, because it seems the logic of your argument is, why aren't you to the conclusion that that the SEC or somebody ought to mandate mutualization? I know you walked away from that because you want to preserve freedom of choice, but the sort of the logic of your argument is, if they're the cheapest, why don't they just mandate mutualization? I'm not saying I support that.
Yep.
I'm just saying that, but that seems to be a logical implication of what you've been arguing.
But one question at a time. Let's
Particularly,
do that one.
It was my birthday yesterday, and my memory is not good enough any longer to remember all 8 questions in a row. So let me take your first one. Well, what about the strength of the independent directors? And let me say that's one of the basic problems I get to in the book which is pervasive to corporate America and in mutual fund America both. Independent directors are there. They have information controlled by the chief executive. In the mutual fund case, in the corporate case, it's the chief executive of the corporation and all the financial officers and so on. In the mutual fund case, it's the chief executive of the management company, who more often than not, and I'll come to the difference in a second, is an employee of the management company. So you have an information asymmetry, I guess one would say, and you basically hear what the management wanted to tell you. I tried to do it quite differently. I would always talk about anything that went wrong in the previous month at our board meetings. I don't know if people still do that or not, but I think it's important to have some sort of objectivity on the part of the chief executive. It was not easy to find. Now, so they need their own sources of information. I believe that step of having your own staff and running the operations side of the business is a very useful step, because all of a sudden you're a company and you can stand up for your own rights, and that's the way, as I mentioned, that Vanguard began. So part of its information, part of its dominance control by strong CEOs, and part of it is, and again I have to say in this context that I think there was a real shortfall in Jeff's study that I don't think anybody else has mentioned, and that is we had the ill grace, Kevin, who's out here with me, my good right arm at Vanguard, Kevin Laughlin, and I had the ill grace to go through all the funds that are in your study, Jeff, and on average they were in the 58th percentile. On average they were in the 58th percentile. Well, I thought, whoa, something's wrong here, and I think you'd have to tell me, but I conclude that the focus was on the A shares with no attribution of sales charge, and not on the B, C, D, G, Y, and F shares, all of which have much higher expenses. And someone like Capital, their rating drops about 15 percentile points if you look at all of the Capital Group funds.
Not if you asset weighted.
Well, I'm speaking of the individually weighted. Well, the asset weighted still wasn't included, and that would be a different number. But we were able to get it down to, I think, 50% just by doing the obvious, taking into account those charges, because sales charges are a bit of much of acquiring that or not. But the study also showed, I believe, the conclusion was wrong on the performance. First, by my standards, the firms that are run by conglomerates had distinctly below average records doing the Bogle adjustment or the Kevin adjustment. And the big distinction was that banks and brokers, I believe brokers, I'm certain of banks, have to, under law, have independent chairmen. When you're...
They did not have to after they changed the class.
Well, they just stayed with their existing structure. But,
that's correct.
And by the way, I have a paragraph in my book, not to expand this too much, of bring back Glass-Steagall, which is something else we really ought to be thinking. We really ought to be thinking about it. Read those paragraphs in there. I mean, a lot of what went on is a permeation of the old Glass-Steagall requirements. So I know it works in the Vanguard case. That's all I can say. You see how it works. A lot of it is an attitude. A lot of it is information. A lot of it is personality. A lot of it is corporate structure. A lot of it is what you're used to. You come on a board and basically your legacy is what the board's done before. I actually had and signed a book for John Connolly, the fellow for Alger Funds who went to jail for the offenses of trying to clean up the books. And he said to me, seemed like a nice guy. He's out of jail for 2 days when I saw him and signed the book for him. I thought that was kind of an amazing coincidence. But he said, I know I did wrong. And I was justly punished. But he said, when I came in, that was the way we did things. It never occurred to me that there was anything wrong with it. I never thought about it. Just did it. We always did it and we'll continue to do it. So inertia is a big part of the problem. But I think given time, we can get there. Unfortunately, time is money.
Time is running out.
This opportunity cost is huge. Sorry, I was a little long-winded, and I'll try and do the next one shorter. I think you had one quickly.
Well, we're going to go to the audience
We'll go
first,
okay.
and then we'll catch you in a sidebar on that issue. Okay, we want to get questions. Danny, you there with a mic? Way in the back, would you please introduce yourself and then ask your question?
Irv Chapman, I work for Bloomberg Radio. Mr. Bogle, what do you think about hedge funds reaching out to your customers unregulated? And what do you think about hedge funds and pension funds speculating in oil futures, driving up the cost of an estimated $10 a barrel or more by some accounts?
I think when the chapter, it's just like when the chapter of the go-go era was written and the chapter of the new economy boom, bubble, was written. This will prove to be, the hedge fund boom will prove to be one more extraordinary popular delusion and madness of crowds. They take huge amounts out of the system. All of them cannot win. The record of hedge funds is maybe semi-demi so-so compared to an average balanced fund, which is the proper standard, over the last 10 years, the great years for them. When you take out 400 guys who were cheating with market timing, I don't know how much the record goes down, but be awful careful when you see enough records, you become quite a cynic. So I'd say it's a boom that will pass, and when you look at, for an individual after-tax returns, hedge funds are just utterly hopeless.
What about the oil space?
I'm against speculation, whether it's oil, real estate, telecommunications stocks, or internet stocks, or any other kind of speculation. It makes no sense for long-term investors.
I'm Matt Fink, a retired mutual fund shareholder. Jack, I must say, to start out, I have to say, Jack, I agree with you about conglomerates. I think everybody has that concern. But I have questions about your solutions, if I can. One of them is to mandate independent chair and 75% independent, like the SEC has proposed. But when you look at the abuses you talked about, the late trading and market timing, the worst ones seem to occur in groups with an independent chair. I think people who've looked at it would say the Bank of America situation, where, as you pointed out up there, by law, under Glass-Steagall, they had to have an independent chair, probably was the most abusive. So I don't see why that helps. It may not hurt, but I don't see why it makes it better. Second, more importantly, going back to mutualization or the kind of halfway house of fund boards having their own staffs. I've been doing a lot of research on history, and if you go back to the 20s, most funds, closed-end funds, and the first two mutual funds, MIT and State Street, were internalized. They were mutualized, yet the worst abuses happened in the 20s, mostly in connection with internalized closed-end funds. So I don't see why that would help. And now we have in the industry for a number of years a couple of fund groups, and Joff would be more familiar with this than I am, that have their own staffs. Putnam and IDS, now American Express, yet now whatever they are, and yet Putnam, at least, I don't remember about American Express, was knee-deep in the scandals. So forgetting philosophy, ideology, but when you look at practicality, we've had examples of both independent chairs and internalized, and they don't seem to have done a hell of a lot. So my takeaway is what separates these different groups mostly is people. If you have Jack Brennan running Vanguard and Paul Hager running Capital Research and Ned Johnson running Fidelity, whether they're internalized, externalized, their own staff or not, you get pretty good corporate governance. At other groups, you could have people with tremendous independence on paper, and you have tremendous abuses. So I put that more as a speech than a comment, but it doesn't strike me that either requiring an independent chair or mandating staffs, I don't see any evidence why they would help.
Well, to respond to the simple one first, I mean, the stuff about the 20s and 30s, it was in fact MIT and State Street that distinguished themselves by honorable conduct and perfectly good performance. The whole closed-end thing was the bubble of that day where there was huge leverage, and we had Goldman Sachs Trading Corp and all those others that were basically, whatever their structure, in business for a completely different reason, a huge marketing of packages of securities to an unwary public at the peak of the market. But mutual funds with independent status in that 30s and 40s, 20s, 30s, and 40s actually acquitted themselves very, very nicely. I have to tell you this, and this is going to be a little harsh form of comment, for which I'm sorry. I'm not sure. I mean, I haven't met, I don't think, any of the really bad, well, one of them, I won't get into his name, one of the really bad apples in the mutual fund business, which each of a certain group of them get a certain thing in my room. The people that are running the mutual fund business are people of great integrity, as far as anything I know. But they're operating in their own little world. I use this quote from Upton Sinclair, it's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it. And they look at themselves as being fiduciaries. Are they really? I don't think they are deep down. They have the intention to be, but they're captives of a structure and an ethic, and everybody else is doing it, is sort of a standard of business these days, so I can do it too. This is the way the industry has always worked, is another thing. Any kind of a change isn't any good. I'm not sure my change, what I recommend, is perfect, but I say, given the results I see and the shortfalls I see, we have to do something, and I can't think of anything better. Maybe somebody will think it tries to balance government and enterprise. I'm not a believer in turning everything over to the government in any way, shape, or form, but I am in favor of requiring certain standards of those who are entrusted with other people's money.
John.
Make a quick comment here, too. Actually, on the independent chair, I think it's an open issue, and I don't think there's enough empirical information and there are differences in anecdotal experiences to reach a solid conclusion. One thing I've pointed to is there are an awful lot of good companies out there that have high standards that are run by interested chairs. And I point out that Vanguard for years and years, and continues today to be run by an interested chair, although Jack has disputed that with me on another occasion. Bob, you seem very interested in the mutualization, and Matt brought it up as well. There's one thing clear out here in the marketplace. There are potentially three forms of organization for a mutual fund business. One is the old internal that you're referring to, where the fund has its own staff and runs and manages it. That disappeared. It's economically inefficient. It is dominated by either the Vanguard form, which is an external form, but the external management company is owned by the mutual funds themselves, or the other form that is prevalent, where there's an external management company owned by has its own owners. There's a free market out there. If mutualization, Bob, can work, then mutual fund management companies can, when they want to change hands, sell it to the mutual fund. It may be expensive, and I tell you, it would be very dangerous to go to the press. Let's say when City Asset Management was sold to Legg Mason, if it had proposed that instead of being spun off to Legg Mason, it was selling it to their shareholders of the mutual funds. I think there's a problem there of how you keep an arm's length distance and put it together. You can't get these management companies to the shareholders without getting compensated if you're owners of them. And that leads me then. Well, okay. I think that answers the question. But I do think, your question of why can't the government mandate it, well, that's an appropriation of value. It's transferring value from the owners of a management company, an ongoing business, to another group without compensation. And that, I think, creates a real obstacle in our free enterprise system.
I just want to be clear, I wasn't advocating it. I was just asking the question.
Well, I was trying to disabuse you of it, just in case.
No, I was just simply saying that's a logical, I thought that would be the logical implication of what Jack was saying, that's all.
Well, okay.
Let's go on. Back. Introduce yourself, Mike.
Mike Eisenberg recently retired.
Another retired. No.
Well, followed Matt. Two observations. One is that the mutual fund scandal was really not just market timing or late trading. There were other abuses which were fairly significant, like the use of fund assets for distribution. Now, if you take a look at something like the Franklin case, the problem was that there was no disclosure to the directors. Indeed, they were misled with respect to the use of inflated commission rates. And that's true in a group of about half a dozen other cases that the Commission brought, which were focused on that. To take out the issue of the independent chair and the 75% independent directors is to separate out part of an overall program which the Commission undertook to help reform the fund industry or help them reform themselves. Because it was the chief compliance officer, it was the prohibition under 12b1 that you can't use fund assets for distribution unless it goes through the 12b1 process. You couldn't use inflated commission rates to do it. That's just one step. What's happened is that people have focused just on the independent chair and the 75% as some kind of magic bullet. It was not intended to be a magic bullet. It was intended to be a step in empowering independent directors and to secure a channel of communications, which, as Jack pointed out, is really not open all the time, and it's more open now than it ever has been. I think certainly one of the things that is not a solution is this unified investment company business where you marginalize the independent directors. You either empower the independent directors or you're going to leave it to the states. Be careful what you wish for.
Do you have a question?
The question is, what do you think?
All right. Do we have any further, unless anyone wants to respond to that question?
I think Mike is right.
Okay. Anyone else have a question? Okay. Well, I do want to thank our panel. I want to thank especially Jack for a wonderful presentation, and our panel was excellent in responding to that. And I want to thank all of you for spending the time learning a little bit about this, as Bob and I have. So a warm hand for our panel. Under the general rubric, is there a better way to regulate mutual funds? This is the 9th conference we've had on this subject. There will be several more. But this one promises to be, I think, one of the most interesting, if not controversial. Our guest and principal speaker today is Jack Bogle, a pioneer in the mutual fund industry and the founder of the very successful and innovative Vanguard Group. I won't go into detail concerning Mr. Bogle's extraordinary career. That's outlined in the biography included in your materials. But suffice it to say that he began looking at the benefits and costs of mutual funds with his senior thesis as a Princeton undergraduate and essentially never stopped. His work as both an innovator and then a critic of the mutual fund industry has earned him, in 2004, Time magazine's listing as one of the 100 most influential men in the world. We were eager to bring Jack Bogle to this podium because his critique of the mutual fund industry has received wide circulation, not just through his books, but through his remarkable speaking schedule and abilities. As the Washington Post once said, he has the mind of an economist and the personality of a preacher. Any study of mutual fund regulation and the structure of the industry, which is what Bob and I are engaged in here, must take into account the Bogle critique, and particularly his recommendations for change, and certainly we will. In his latest book, The Battle for the Soul of Capitalism, which incidentally is on sale in the lobby, and you can get it after the program, or if you're leaving early, you can get it then. Mr. Bogle outlines his prescription for reform. He cites 4 elements in his reform agenda. No more than 1 management company director on a fund board, an independent chair, a fund staff reporting to the independent chair with responsibility for evaluating the investment performance and marketing results of the manager, the reasonableness of fees paid and other relevant information, and a federal statute of fiduciary duty for fund directors. We're eager to hear Mr. Bogle's arguments in favor of these reforms for several reasons. Clearly, this fits in with the kind of study that we have been doing. First, the SEC's 2004 regulation that would have required the chair and at least 75% of the directors of every fund to be independent of the investment advisor was recently struck down by the D.C. Court of Appeals. Because the SEC had failed to consider the effect of its rule on efficiency and competition in the mutual fund industry. In the National Securities Market Improvement Act of 1996, Congress required the SEC to consider these factors, that is, efficiency and competition, when it makes rules. And Bob and I think, certainly I, because I've written a lot about this, would really like to know how Mr. Bogle connects the independent chair and the supermajority of directors with efficiency and competition in the mutual fund industry. Secondly, the only significant scandals in the industry 66-year history were the recent market timing and late trading scandals. Both were discussed extensively in Mr. Bogle's book. The SEC proposed its requirement for an independent chair and an independent supermajority of the board largely as a response to these scandals, and thus essentially implemented two of Mr. Bogle's major reforms. I've been trying to figure out how this reform, had it been in effect, would have prevented these scandals. The SEC has never charged
Reformers were publicly held. I don't know how to do a correlation on that chart, but I don't think we need to bother. 3, mutual fund returns have fallen dramatically short of market returns, proving the validity of that take-make trade-off. The more we take, the less you make. The gap comes to almost exactly the mutual fund returns from the market, the exactly amount of cost they incur, all those management fees and operating expenses and front-end sales charges amortized for the purposes of these data over 10 years, 12B1 fees, hidden portfolio transaction costs, all in costs that in fact come to something like 2.5% or more, even more per year. How could it be otherwise then? In the past 25 years, for example, the average equity fund has fallen short from the Standard & Poor's index return by 2.5 percentage points a year, just about the same as those costs, and largely because of those pesky fund costs. Gross return minus cost equals net return. Please don't forget it. Judge Brandeis gave me a great phrase for that. The relentless rules of humble arithmetic, and they apply to the mutual fund industry as well as every other industry around. A return of 10% I should say, in a 12.5% market is obviously a shocking gap, but the reality is much, much, much worse than that. As a marketing business versus an investment profession, we bring out these new funds based on the choices of the day and draw in the investing public often at exactly the wrong time. Call it the timing penalty, and I call it the selection penalty. Together, the average fund investor lags the average fund by nearly another 3%. That's actually 2.7%, leaving the investor with a net return of just 7.3% a year, compounded to 4,820 compared to 17,000, or 28% of the market's return. But don't forget that those are nominal returns. They have to further reduce them to a real return of about 4% after we take a 3.3% inflation rate out. When compounded over this grand 25-year era for investing, the average fund investor has captured 22% of the market's real after-tax, pre-tax return. I'm not kidding. You can see it in this chart. $1,000 investing in a simple index fund, it happens to be ours, produced a net profit after inflation but before taxes of $7,620, to which I say, hooray for the magic of compounding returns. But for the average fund investor, the real profit came to $1,670, 1/5 as much, to which I say, boo to the tyranny of compounding cost, which overwhelm the magic of compounding returns. If we adjusted those figures for taxes, and funds are horrendously tax inefficient, it would get even worse. These are not mere abstractions. These are the differences between a secure retirement and a need to depend on a Social Security system that is itself deeply troubled. The opportunity costs that you see in that chart given up by fund owners are enormous. And if future returns are not 12.5%, think about this for a minute, but more like 7.5% on equities in nominal terms, and I think that's not a bad number. It seems to be at this time a sign of a consensus return. The after-tax, real after-cost, after-tax real returns of the typical mutual fund investor in that environment would be about 0. Do the math. I won't do it for you. Number 4, soaring costs in this industry. If fund assets have burgeoned during this great bull market, the greatest bull market in history, costs borne by fund owners have incredibly increased at an even faster rate than assets have grown. From 1980 to 2005, for example, as assets soared from $45 billion to over $4 trillion, the expense ratio, the average equity fund, actually rose from 0.94% to 156. 66% increase. And a lot of people want to use an asset-weighted basis. Fair, given, as the book states, and as your invitation to this system, this session repeats, this morning session repeats, quote, an organizational design that would amaze and delight the oligarchs of corporate America, under which the managers of mutual funds have enjoyed virtually free rein to place their interests ahead of the interests of the owners of their funds. Just think about just these two, and I could go way on beyond this, that differentiate mutual fund America from corporate America. Fund complexes, even when their assets exceed $100 billion or $1 trillion, and they do, could easily manage themselves. Yet they find it necessary to be controlled and operated by separate outside managers who are in a business to serve their own shareholders. And number two, another difference, mutual funds are owned almost entirely by investors of modest means, relatively modest means, with very few of those potentially only at the moment, pesky giant institutional owners to be concerned with. As a result, the sound national policy promulgated in the preamble to the Investment Company Act of 1940 that clearly ordains that funds must be organized, operated, and managed, remember those three words, in the interest of their shareholders rather than the interest of their managers and distributors, end of quote, has been honored for far more in the breach than in the observance. It's the disregard of this principle that the interest of shareholders comes first that explains why mutual funds have, as a group, failed to adequately serve their owner investors. It is not just theoretical. The evidence is real and the evidence is tangible. Let me illustrate this point with 6 of the major areas that I see as problems. 1, the mutual fund has changed in the time I have been in it for the worse. All those years ago, as I saw it at least, it was a profession with elements of a business. And it gradually became a business with elements, and too few elements of that, of a profession. Our traditional guiding star of stewardship was largely replaced by a new star, salesmanship. Focused on management. When I wrote that Princeton thesis all those years ago, our predominant focus today is on marketing. The name of the game is increased fee revenues to managers by building up assets under management, often by creating, promoting, and advertising speculative funds that meet the fads and fashions of the day at a staggering cost to fund investors. Point 2, this industry has been taken over by financial conglomerates. When I entered this field all those years ago, first chart, virtually 100% of mutual fund management companies were privately held firms, relatively small firms, and managed by investment professionals. Today, the vast majority of our largest fund management companies are publicly held. Look at that change. Largely owned by giant financial conglomerates that are managed by businessmen, bereft of professional investment training. Think about it. These conglomerates are in the fund business to earn a return on their capital, not a return on your capital as a fund investor. That's what the business is all about. They cannot do justice to both because the more the managers take, the less the investors make. The record is very clear on this point. Over the last decade, using the figures that Jeff Bobroff had done for Fidelity, we've made some few changes. I don't know how well you can read this, but the fund shown, and this is ranking down the 3 columns, first column, second column, third column, performance rank based on percentile rank against competition across the board, as fair a way as you can really to look at fund performance. The yellow firms at the top of the list are privately held firms. The white firms are conglomerate-owned firms, and the gray firms are publicly held but not owned by conglomerates. You can see that all seven of the top performing fund complexes were privately held, and 32 of the bottom 34, as a wise man once said, somewhat out of the mainstream, and indeed they are. But I thank you for the nice introduction, Peter, and it's a real pleasure to be at AEI, be with some industry-savvy participants like John and Jeff, and also these think tank intellectuals at the same time, like Peter and Bob. It's really a treat to be with you, and I love the challenge of that. I'm going to start off by just mentioning, as a jumping off point, the new book that I have, Battle for the Soul of Capitalism, published by Yale University Press just last November, and it relates directly to the themes I'll talk about today. The theme of the book is that today's capitalism has departed in many, many areas, and not just in degree but in kind, from its traditional roots, a system that served us so well for so long. The system worked, or at least it did work. And then late in the 20th century, something went wrong, a pathological mutation in capitalism, as it's called in the book, in which the traditional system, the classic system, owner's capitalism, based on a dedication to serving the interests of the corporation's owners and maximizing the return on their investment, morphed into a new system, manager's capitalism, in which the corporation came to be run to profit in the corporate area, its managers, in complicity with accountants and the managers of other corporations. This change came in large measure because the markets had so diffused corporate ownership that no responsible owner exists, a corruption of capitalism itself, quoting from the book. Once we were an ownership society, not so long ago either in the whole span of time, in which direct owners of stock held voting control over corporate America, and we've turned in now an agency society, and we are not going back to an ownership society. This move has been massive and unrelenting. As you all know, roughly in 1950, 92% of all stock was held by individual investors and only 8% by institutions. And since then, institutional ownership has soared to 68% from 8%. But while we've replaced our traditional ownership structure, dominated by individuals, with a new agency structure dominated by institutions, we have yet to change the rules of the game. It's a curious fact that my new book echoes, in fact, Peter, in so many ways the principles that I set forth in that senior thesis at Princeton all those years ago, completed in the spring of 1951. Oh my God, 55 years ago. It was entitled The Economic Role of the Investment Company. Read today, I think you would find that the thesis maybe a little bit more than workmanlike, but not much, probably rather callow, but it powerfully, as it happens, reaffirms the ideals that I hold to this very day. The role of the mutual fund, I'm quoting from the thesis now, is to serve the needs of both individual and institutional investors, to serve them in the most efficient, honest, and economical way possible. The prime responsibility of fund managers must always be to their fund shareholders. The primacy of the interest of the owners, getting back to the theme of the book, of fund shares, over the interest of the fund's managers. All of this gratuitous advice from a callow college senior was, of course, totally ignored by the fund industry. And the 1974 creation of Vanguard, however, as a truly mutual fund group, operated on an at-cost basis for the benefit of the community of owners rather than the private interest of its managers, was my attempt, it turns out, to walk the walk that I had talk about all those years earlier. Today, probably be evident in my comments this morning, my youthful idealism has not departed. I think it's somewhat worse, shamelessly reflected not only in Vanguard, but in the new book, and certainly in the commentary you'll hear from me this morning. The pages of the Battle for the Soul of Capitalism divided into three roughly equal sections: corporate America, investment America, and mutual fund America. But I'm going to focus today, of course, on the mutual fund part of that. The fund industry is, in fact, the paradigm, the poster boy, if you will, of the triumph of managers' capitalism over owners' capitalism.
Any directors, independent or otherwise, with dereliction in connection with the clearly wrongful acts by the fund's advisors, and has never suggested that the directors should have or even could have discovered the wrongdoing. So I have never been able to determine how increasing the number of independent directors from a majority to a supermajority, or making the chair independent of the investment manager, would have been a remedy for the one serious scandal that has ever afflicted this industry. Since it is an important part of his prescription for reform, I am hoping that Mr. Bogle will draw the connection between the reform and the wrongdoing. Third, in his book, Mr. Bogle argues that expenses imposed by investment managers have eaten up very large percentages of the returns that investors might have expected from the growth in the value of their funds. Yet he recommends that the funds themselves have a paid staff to evaluate the work of the investment advisor. Presumably that would add even more costs that ultimately would reduce the yields that investors would get from appreciation of their portfolios. Mr. Bogle does not estimate what these costs could be, but if we were to adopt his idea, I'd like to get some sense of what he thinks these costs might be and how they would increase the returns for investors. More generally, like Jack Bogle, Bob and I are focusing our study on what reforms will improve the returns that investors will get from their mutual fund investments. In looking at mutual funds today, we see an industry with nearly $9 trillion in assets, heavily regulated by the SEC, and largely under the control at the board level of a majority of independent directors, and in many cases, a supermajority. From this arrangement, investors obtain diversification that protects their nest eggs against the kinds of losses suffered by the non-diversified shareholders of, we'll say, Enron and WorldCom. But far from being dissatisfied with what this arrangement is costing them, there are indications that investors are willing to pay even more for investment advice. If I understand the figures correctly, almost 60% of mutual fund investors use financial advisors. Most of them are paid in whole or in part by the investors themselves or through 12b-1 fees that are, in effect, paid by mutual fund shareholders. And how else can one explain the growth of separately managed accounts in which investors pay advisors to set up special, customized, diversified portfolios? One of the alternatives we might consider in our study is the adoption of the reforms that Jack Bogle recommends. But in order to do so, we'd have to see how these reforms cure the problems Mr. Bogle cites or give investors more of what they seem to want. We look forward to Mr. Bogle's remarks, as I'm sure you do, and to the discussion that follows. And now I'm delighted to welcome to the podium Jack Bogle. I will introduce my colleague Bob Lighton and the other speakers after Jack is finished. Please.
All right. I'm sorry about that one. I repeat myself. I'm not sure I've got covered in my talk all of the items that Peter mentioned in his generous introduction. But if we haven't covered them in the talk, we will certainly talk about them in the Q&A period. And I hope this will be a no-holds-barred session. And it's very rare for me to get any debate on these ideas I have, which seem to be